Since September 2024, one fund category has outperformed most investors' expectations. While during this period, Nifty 50 and Nifty 500 fell nearly 6% and 4% respectively, these funds still managed to generate around 9% CAGR. When most investors were focused on equity market volatility, this category quietly generated strong risk-adjusted returns by dynamically allocating across equity, debt, gold, silver, and arbitrage. Here we are talking about multi-asset allocation funds. In just 1 year, assets in this category surged from 1.13 lakh crore rupees to nearly 1.87 lakh crore rupees, which is a massive 65% jump. In fact, in just 1 month, which is January 2026, investors poured 10,000 crore rupees of fresh cash into these funds. So, what exactly makes these funds so popular and effective amid tough market conditions? In this video, we will break down 5 things. Number 1. What are multi-asset funds? Number 2. Why do returns vary so much within this category? Number 3. The taxation angle most investors miss. Number 4. How do these funds perform across market cycles? And number 5. How should they fit into your portfolio? Let's start with segment 1. What are multi-asset funds? To understand why this category worked so well recently, we first need to understand one simple investing principle. Different asset classes perform differently across different market cycles. There are periods when equities dominate, there are phases where debt becomes more stable. And during global uncertainty or geopolitical stress, commodities like gold and silver often outperform. That's exactly the philosophy that multi-asset allocation funds are built on. SEBI mandates that these funds must invest at least 10% each in at least 3 different asset classes, typically equity, debt, and commodities like gold or silver. Instead of depending entirely on one market, these funds spread risk across multiple assets. And that diversification becomes extremely valuable during volatile periods. For example, during phases where Indian equities corrected sharply, exposure to gold, silver, global equities or debt helped cushion portfolios and stabilize returns. In many cases, these non-equity allocations didn't just reduce downside, they actively contributed to portfolio gains. And that is what makes multi-asset funds unique. Not maximum returns every year, but smoother investing across cycles. Now, most investors tend to treat all multi-asset funds as if they're exactly the same. But the reality, returns in this category over the past year ranged from a tiny 4% to a spectacular 26%. That brings us to the second segment. How are different funds allocating money today? As we discussed earlier, every multi-asset fund must hold 10% in 3 assets. How they manage the remaining 70% is completely up to the fund manager. Let's look at how the most popular funds are actually structured right now. At one end, there are funds that maintain 65% or more in equities to qualify for equity taxation, while using the remaining allocation across debt, gold, and other asset classes. Funds like ICICI Prudential Multi-Asset Fund broadly follow this approach. At the other end are funds that take a more balanced approach, keeping equity exposure closer to 35 to 50% and allocating a larger portion to debt, gold, and global assets. Funds like DSP Multi-Asset Allocation Fund and SBI Multi-Asset Allocation Fund generally fall into this category, with a greater focus on downside protection and stability. The difference in asset allocation can have a meaningful impact on both returns and risk, especially across different market cycles. This explains the variation in their returns. Now, let's talk about one of the most misunderstood aspects of multi-asset funds, which brings us to the next segment, the taxation angle most investors miss. Based on their portfolio construct, multi-asset funds are divided into 2 main tax buckets. Bucket 1, equity-oriented, where equity is more than 65%. If a fund maintains 65% or more in Indian equities, it is taxed like an equity fund. If you sell within 12 months, any gains are taxed as short-term capital gains at 20%. If you hold the investment for more than 12 months, the gains qualify as long-term capital gains and are taxed at 12.5%. Bucket 2, non-equity, where equity exposure is more than 35%. If a fund has between 35 and 65% invested in equities, its taxation is different from equity funds. If you sell your investment within 24 months, any gains are added to your income and taxed as per your income tax slab. If you hold it for more than 24 months, the gains qualify as long-term capital gains and are taxed at a flat 12.5%. However, unlike equity funds, you do not get the 1.25 lakh annual LTCG exemption. Now, here's one more important nuance. Just because some funds have more than 65% equity allocation, it does not mean they're more risky. Many multi-asset funds use arbitrage and other hedging strategies to maintain at least 65% gross equity exposure. Here, fund managers are not necessarily betting on market direction. Instead, they capture small price differences in the same stock across different markets, like buying in the cash market and selling in the futures market. This helps reduce volatility during sharp market falls, while these positions still count as equity for taxation purposes. So, even if headline equity allocation looks high, the actual portfolio risk can be much lower. Which brings us to the next segment. How do these funds perform across market cycles? One of the biggest advantages of multi-asset allocation funds is downside protection. Historically, the category has fallen less than broad equity indices like the Nifty 500 during market corrections. That's because they're not dependent on a single asset class. Alongside equities, they also allocate across debt, gold, silver, global equities, and also use arbitrage strategies. However, the level of protection can vary significantly from one fund to another. For example, a fund with higher allocation to debt, gold and arbitrage is likely to experience smaller drawdowns during market stress. As you can see, White Oak Capital and Quantum Multi-Asset Allocation Fund have a lower net allocation to equities than most of their peers. And this lower exposure helps reduce overall fluctuations in returns, resulting in a lower standard deviation. On the other hand, a fund with a larger equity allocation may participate more in market upside, but could also witness deeper corrections when equities fall sharply. As you can see, UTI and Baroda BNP Paribas multi-asset funds have a higher net allocation to equities compared to most funds in the category. Since equity exposure typically increases portfolio volatility, these funds have also recorded a higher standard deviation than their peers. During strong bull markets, pure equity funds will often outperform because they remain almost fully invested in stocks. Multi-asset allocation funds, by design, always have a portion of their portfolio allocated to non-equity assets. But over a full market cycle, this diversified approach can lead to a smoother investment journey, better downside protection, and potentially stronger risk-adjusted returns compared to a pure equity portfolio. So the real objective of multi-asset investing is not necessarily maximizing returns every single year. The aim is to improve risk-adjusted returns and reduce portfolio volatility. This strategy helps investors stay invested through difficult market cycles. So how should they fit into your portfolio? That depends entirely on your risk profile and how much stability you want in your portfolio. For aggressive investors, allocation can go around 10 to 15%. For balanced investors, around 20 to 25%. And for conservative investors, around 30 to 35%. Typically, the more conservative your portfolio is, the larger the role these funds can play in reducing volatility and cushioning market falls. So, what's your strategy during this volatile phase? Are you holding any multi-asset allocation funds in your portfolio? Let us know in the comments below, and don't forget to subscribe to PowerUp Money for more insights on mutual funds and investing.